Gold didn't crash. And that's exactly why this moment matters more than most people realize. Because markets usually scream when something breaks, but the most important shifts happen quietly, when something refuses to happen at all. Rates were high, the dollar was strong, risk sentiment was unstable, and every historical model said gold should have fallen hard. But it didn't. It held. And when a market refuses to behave the way it's supposed to, that's not randomness. That's information. If you've been watching gold expecting a collapse that never came, you're not alone. Traders were positioned for it. Commentators were calling for it. Headlines were written in advance. And yet gold stayed bid, absorbed selling pressure, and refused to roll over the way it has in past cycles. By the end of this video, you'll understand why gold behaved differently this time, what changed underneath the surface, and what signals actually matter now if you want to understand where gold goes next. To understand why this matters, we need to start with what usually happens. Historically, gold is sensitive to three things above all else: rising interest rates, a strengthening dollar, and risk-on behavior in financial markets. When rates rise, gold typically struggles because it doesn't yield interest. When the dollar strengthens, gold often weakens because it's priced in dollars. And when markets chase risk, gold tends to lose attention. This relationship has repeated so many times that it became almost automatic. Higher rates meant weaker gold, strong dollar meant weaker gold, calm markets meant weaker gold. That was the script. This time, all of those conditions showed up. Rates stayed elevated, the dollar remained resilient, volatility spiked and then cooled, and yet gold did not collapse. It didn't even meaningfully break down. Instead, it stabilized, consolidated, and quietly absorbed pressure. That's the first signal that something changed. Markets don't just ignore gravity unless there's a counterforce holding them up. The first thing that changed is how gold is being held. Gold is no longer primarily trading like a speculative asset in this phase. In previous cycles, gold ownership was dominated by fast money, leveraged positions, and momentum-driven flows. That kind of ownership makes price fragile. When conditions turn, those holders sell quickly. This time, the composition of buyers looks different. A larger portion of gold demand is coming from entities that don't trade headlines, don't react to daily volatility, and don't care about short-term price swings. When ownership shifts from traders to holders, price behavior changes. Think of it like the difference between a house owned by renters and one owned by long-term residents. Renters leave at the first sign of trouble. Long-term owners stay through storms. Gold's recent behavior suggests it's being held more like insurance than a trade. And insurance doesn't get sold just because the weather forecast looks better for a few weeks. The second change is who the buyers actually are. In previous cycles, gold demand surged primarily from Western investors reacting to fear. That kind of demand is emotional and cyclical. It comes fast and leaves just as fast. This time, a significant portion of demand is coming from buyers who don't appear in daily volume spikes and don't chase price momentum. Central banks, sovereign entities, and long-term allocators have been quietly accumulating gold regardless of short-term macro noise. These buyers don't care if gold is up or down 5% this month. Their time horizon is measured in years, not weeks. Imagine an auction where one bidder raises their hand loudly every time the price dips, while another bidder silently waits and absorbs supply without signaling urgency. The second bidder sets the floor without creating excitement. That's what gold demand looks like right now. It's not explosive, but it's persistent. And persistent demand changes how markets react to pressure. The third shift is that gold has partially decoupled from its usual short-term triggers. In the past, gold reacted mechanically to rates, the dollar, and equity volatility. This time, those relationships weakened. Gold didn't surge, but it also didn't break. That kind of muted reaction suggests the market is treating gold less like a macro trade and more like a structural asset. It's behaving less like something to speculate on and more like something to hold. Think of it like shock absorbers on a car. In rough terrain, a car without shock absorbers jolts violently. With shock absorbers, the same bumps are absorbed smoothly. Gold's price action suggests that something is absorbing volatility. And when volatility compresses in an asset that historically reacts strongly to macro shocks, it often precedes a repricing rather than a breakdown. The data supports this interpretation. Gold drawdowns during recent pressure were shallower than in past cycles. Volatility measures compressed instead of expanding. Selling pressure appeared, but follow-through was limited. Importantly, when price dipped, it didn't trigger cascading liquidations the way speculative markets do. That tells us leverage is lower and ownership is stronger. Markets that are weak break quickly. Markets that are changing tend to go quiet first. Another important signal is what didn't happen. Gold did not see panic selling. It didn't experience forced liquidation events. There was no rush to exit. In previous cycles, moments like this produced sharp spikes in volume as weak hands rushed for the door. This time, volume remained controlled. That's not bullish euphoria, but it's also not fear. It's something more stable, and stability at elevated levels is rarely meaningless. History gives us useful parallels. There have been moments before when gold refused to fall even when conditions said it should. In those moments, the market wasn't immediately rewarded with explosive upside. Instead, gold often entered a period of frustrating stability before eventually repricing higher. Those who expected immediate fireworks were disappointed. Those who understood structure were positioned. One example comes from periods where gold consolidated while real yields remained elevated. Instead of collapsing, gold moved sideways, frustrating both bulls and bears. Eventually, when macro conditions shifted slightly, gold repriced quickly because positioning was already clean and supply was tight. The move didn't come from excitement, it came from pressure building quietly underneath. Another example comes from periods where gold held firm while other assets broke down. In those moments, gold didn't surge immediately. Instead, it acted as a quiet anchor. Once broader confidence eroded, gold became the beneficiary not because it was hyped, but because it had already proven it wouldn't break. Markets remember that kind of behavior. So what are the possible paths from here? There are three broad scenarios, and understanding them matters more than predicting which one will happen. The first scenario is that gold eventually resumes its old behavior. Rates stay high, the dollar strengthens further, and gold finally breaks down. This scenario would require a shift in ownership back toward speculative holders and a meaningful reduction in long-term demand. It would likely show up first in rising volatility and increasing selling pressure on rallies. So far, we haven't seen that. The second scenario is that gold enters a prolonged period of stability. No crash, no breakout, just slow movement that frustrates everyone. This scenario tends to shake out impatient participants while allowing long-term accumulation to continue quietly. It's not exciting, but it's structurally constructive. This scenario remains very plausible if macro conditions stay mixed and buyers remain steady. The third scenario is a slow grind higher without hype. Gold doesn't explode upward. It simply starts making higher lows and absorbing supply at slightly higher levels over time. This kind of move often goes unnoticed until it's well underway. It doesn't feel like a bull market at first, it feels boring, but boring markets often become important ones. Each scenario has invalidation points. A sudden spike in volatility and aggressive selling would challenge the stability thesis. A breakdown in long-term demand data would challenge the structural shift idea. A sharp change in policy expectations could accelerate repricing. The key is not guessing, but watching which signals appear first. So what should you actually watch? Not headlines, not daily price fluctuations. Watch volatility behavior. Watch how gold reacts to bad news rather than good news. Watch whether dips are met with urgency or indifference. Watch whether selling creates follow-through or gets absorbed quietly. These behaviors tell you far more about market structure than any single macro data point. One of the biggest mistakes investors make is assuming that markets must always move dramatically to signal importance. Sometimes the most important signal is refusal. Refusal to fall, refusal to panic, refusal to behave the way everyone expects. Gold is sending that kind of signal right now. This brings us to the psychological side. There are three types of people watching gold right now. The first group is waiting for a crash. They've been told for years that higher rates mean lower gold, and they're anchored to that narrative. Every day gold doesn't fall frustrates them. The second group is chasing breakouts. They want gold to explode higher immediately and get bored when it doesn't. The third group is watching structure. They don't need gold to move today. They're paying attention to how it behaves. Which group you belong to matters more than whether gold goes up or down next week. Markets reward patience when structure is changing. They punish impatience when narratives lag reality. If gold didn't fall when everything said it should have, the question isn't whether gold is bullish or bearish. The question is what kind of market gold is becoming. Is it still a trade, or is it transitioning into something more strategic again? The answer to that question will determine how gold behaves in the years ahead, and that answer won't come from predictions. It will come from observing behavior. Gold is telling a story right now, not loudly, not dramatically, but clearly enough for those willing to listen. So let me leave you with this thought. Markets don't change when prices move, they change when relationships break, and the relationship between gold and the forces that used to control it is not what it used to be. Gold didn't fall. Something changed. Drop a comment below and tell me what you think that change is. Is gold becoming insurance again? Is this just a pause before another cycle? Or is the system itself shifting in ways most people aren't ready for yet? I read every comment, and the strongest arguments will shape the next video. Stay patient, stay observant, and remember, the most important moves in markets don't announce themselves. They reveal themselves quietly, one non-event at a time.